Ray Dalio isn't just another investor, he's a legend in the world of finance. Did you know that his hedge fund, Bridgewater Associates, manages over $150 billion in assets? That's more than the GDP of many countries. His unique approach has consistently outperformed the market, even during economic crises. For instance, during the 2008 financial meltdown, while most investors were panicking, Dalio's fund grew by 9.5%. How did he do it? In this video, we'll uncover 6 of Dalio's key investment philosophies that you can start using today. We'll explore his powerful strategy of diversification, dive into his concept of the economic machine, and learn why embracing reality is crucial. We'll also discuss the importance of radical transparency, the benefits of thoughtful disagreement, and how to predict and leverage market cycles. Ready to transform your investment game? Let's dive into the genius of Ray Dalio and discover how you can apply his proven strategies to achieve financial success. Stick around for insights that could change the way you think about investing forever. Chapter 1. The Power of Diversification, Beyond the Basics. When Ray Dalio talks about diversification, he's not just suggesting you spread your bets. He's advising a strategic balance that reacts distinctly under various economic scenarios. Think of it as not putting all your eggs in one basket, but choosing different baskets based on the weather forecast. Dalio famously said, "Diversification is both observed and sensible, a rule of behavior that does not imply diversification can never work, just that it is less likely to." This emphasizes not just the range of assets, but the logic behind their selection. For instance, during economic downturns, bonds often perform better than stocks. Dalio's approach would have you balance these to weather financial storms. In 2008, when the financial world was in turmoil, Dalio's hedge fund, Bridgewater Associates, saw a remarkable positive return of 9.5%. This was largely due to their diversified investments that were tailored to different economic outcomes. Contrast this with the average hedge fund, which plummeted by about 19% that year. What's fascinating is Dalio's method of diversification extends beyond traditional assets. He includes investments like gold and commodities, which often move counter to stocks and bonds. By analyzing historical prices, Dalio's team can predict how these assets perform under different conditions, crafting a portfolio that stands resilient across various economic cycles. For a personal investor, this means looking at your portfolio and asking, how will each asset respond if the market drops? Or if interest rates rise? It's not just about having a variety of investments, but understanding why each piece is in your financial puzzle. Chapter 2. The Economic Machine. Insights you can't ignore. Ray Dalio simplifies the complex economy into a machine-like process. His model revolves around 3 major forces: productivity growth, the short-term debt cycle, and the long-term debt cycle. By understanding these, investors can better predict market movements and make smarter choices. Dalio's description of the economy as a machine is compelling. Think of it as a simple machine, but one that is made up of thousands of moving parts. Each part is a transaction, he explains. This visualization helps investors see the economy not as a chaotic, unpredictable mess, but as a system where cause and effect govern. A critical component of this system is the short-term debt cycle, typically lasting about 5 to 8 years. It's characterized by rising debts and increasing spending, which eventually leads to a recession as the cycle resets. Observing these cycles helps predict when to tighten or loosen your investment approach. The long-term debt cycle, which can last up to 75 years, involves nations and major economies and ends with a significant debt crisis. Knowing where we are in this cycle can be crucial. For instance, the US faced its major debt restructuring in the 1930s and again in the 2000s. Recognizing these patterns can give clues about future market directions. Dalio's insights allow investors to position themselves by understanding economic indicators like inflation rates, GDP growth, and interest rates. If inflation rises, it might be time to adjust your holdings in treasury bonds or real estate, which tend to act differently under such conditions. Through this lens, investing becomes less about guessing and more about strategic forecasting. Dalio teaches that by understanding economic principles and cycles, we can design portfolios that capitalize on these patterns rather than fall victim to them. This proactive approach is fundamental for anyone looking to navigate the complexities of investing with confidence. Chapter 3. Culture of Radical Transparency and its Investment Merits. In any of Ray Dalio's discussions, the principle of radical transparency stands out. It's not just a policy but a culture that encourages open honesty and sharing of opinions. Dalio believes this transparency helps eliminate bad decision-making rooted in ego or blind spots. Truth, more precisely, an accurate understanding of reality, is the essential foundation for any good outcome, Dalio writes. This philosophy underpins his approach to investment decisions at Bridgewater Associates. Here, every meeting and every decision-making process is recorded, ensuring that all team members can challenge and understand the rationale behind each move. This level of openness might seem daunting, but the results speak volumes. For instance, Bridgewater's strategies have consistently outperformed the market due to a team's ability to point out flaws in logic and strategy openly, without fear of retribution. This ensures that only the best ideas survive. For individual investors, adopting this principle means seeking feedback and different perspectives on their strategies. It could be as simple as discussing your investment ideas with a diverse group of people or joining forums where your assumptions can be tested. The key is to be open to criticism and to use it constructively to refine your investment decisions. Investing, according to Dalio, should not be a solitary journey. Involving others not only enhances your understanding but can also expose potential errors in your thinking before they cost you financially. It's about leveraging collective wisdom for personal gain. Chapter 4. Embrace reality. Investing in alignment with the world. Dalio's investment strategies are deeply rooted in realism. He advises investors to see the world as it truly is, not as they wish it to be. This alignment with reality is crucial, especially in today's fast-paced global economy. Embracing reality and dealing with it well is what separates success from failure, Dalio asserts in his principles. This means acknowledging market trends and economic signals rather than relying on hopeful speculation. For example, during the tech bubble of the early 2000s, many ignored the reality of overvaluation, leading to significant losses when the bubble burst. Understanding and acting on real economic indicators, like changes in unemployment rates, consumer spending, and manufacturing data, can provide a solid foundation for investment decisions. These indicators often dictate market trends and can guide where and when to invest. For instance, if unemployment rates are rising, it could be a sign to reassess positions in consumer discretionary stocks, as higher unemployment typically reduces consumer spending. Conversely, a spike in manufacturing output might signal a good time to invest in industrial stocks, anticipating economic growth. Dalio's realism extends to understanding geopolitical tensions and their impacts on markets. He studies global events not just for their immediate effects but for their long-term implications on economic stability and growth. This comprehensive worldview enables investors to anticipate market shifts rather than react to them. Adopting this principle means staying informed, constantly educating yourself about global and local economic conditions, and adjusting your investment strategy accordingly. It's about being proactive rather than reactive, ensuring your investments are aligned with the realities of the world's economic dynamics. Chapter 5. The Power of Knowing What You Don't Know, the Principle of Thoughtful Disagreement. Ray Dalio places immense value on the principle of thoughtful disagreement. This concept is about embracing the diversity of thought among team members or fellow investors to refine strategies and prevent overconfidence. Dalio asserts, if two people agree, there's no point in them both using up their time thinking about the same thing. This philosophy encourages investors to actively seek opinions that challenge their own. For example, if you're bullish on a particular stock, consulting with someone bearish on it can expose potential flaws or risks you might have overlooked. Bridgewater Associates practices this by fostering an environment where challenging others' views is expected and encouraged, leading to more robust investment decisions. In practical terms for individual investors, thoughtful disagreement can be applied by participating in investment clubs or online forums where debates on stocks, bonds, and other assets are common. It's about being open to changing your mind, not just defending your position. This method reduces the risk of making decisions based on biases or incomplete information. Statistically, diverse teams make better decisions. A 2017 study by the Boston Consulting Group found that companies with diverse management teams had a 19% higher revenue due to innovation. This underscores the value of diverse perspectives in complex decision-making scenarios like investing. Chapter 6. Predicting and Leveraging Market Cycles, a Dalio Blueprint. Understanding and leveraging market cycles is a cornerstone of Ray Dalio's investment philosophy. He believes that by studying past market behaviors, investors can predict future market movements with better accuracy. Everything is another one of those, Dalio writes, suggesting that patterns in the market repeat over time. Dalio breaks down the financial market into various cycles, such as credit, interest rates, and business cycles, and examines the historical data to forecast future trends. This approach was pivotal during the 2008 financial crisis, where Dalio's correct reading of the market cycles led Bridgewater to positive gains while many others faced losses. Investors can utilize this strategy by studying long-term market data to identify patterns. For instance, recognizing that a bull market often follows a bear market can help in timing investments to capitalize on eventual recoveries. Tools like moving averages, economic indicators, and market sentiment analysis can aid in this predictive approach. Furthermore, understanding that markets are driven by both emotion and economic fundamentals can guide when to buy or sell. Dalio often discusses how human nature drives market cycles through greed and fear, and recognizing these emotions in market behavior can be a key strategy for investment timing. Applying Dalio's cycle analysis involves continuous learning and observation. It's not about predicting the exact moment the market will shift but understanding the signs that a shift is coming. This proactive approach helps investors stay one step ahead, making calculated decisions based on informed predictions rather than reactive moves.